Welcome to Delphos Insights. This is episode 27, where we examine how to attract impact funds in 2026. Lessons from real term sheets. In today's capital environment, attracting impact capital is no longer driven by compelling narratives alone. Impact funds now operate with institutional discipline. Capital flows to projects that combine measurable outcomes with commercial viability, supported by clear financial models and credible impact metrics.
And if you are listening to this as an institutional investor, a chief financial officer, maybe a private equity leader, or a sovereign wealth fund manager,
Or a development finance institution leader, or a founder raising capital for projects in emerging markets.
right, exactly. If you are in any of those seats, this analysis is tailored directly to your strategic priorities. We are going to explore why impact investing increasingly requires projects to meet strict institutional investment standards.
Standards for governance, financial performance, measurable outcomes, and highly disciplined capital allocation. Okay, let's unpack this. We must begin by looking at the sheer scale of the market to really understand why this institutional discipline has become absolutely mandatory.
It is the scale that dictates the rules now. The global impact investing market currently exceeds $1.6 trillion in assets under management.
1.16 trillion US dollars. I mean, to contextualize that, you have to view modern impact investing not as some philanthropic side project, but as a fully matured, cutthroat asset class.
It is entirely cutthroat. And that brings us to the baseline math. How does this fundamental shift alter the math for project sponsors seeking to raise capital today?
Well, the baseline math is fundamentally recalibrated because the underlying expectations of capital allocators have evolved. Historically, impact investing often involved a concessionary mindset,
Right, there is this implicit assumption that investors would accept lower financial returns in exchange for positive social or environmental outcomes.
Exactly. But that is no longer the prevailing reality. Today, more than 90% of impact investors explicitly target market rate returns.
More than 90%. That means an impact project does not merely compete against other impact projects for allocation. It is in direct competition with traditional, purely commercial investments on a risk-adjusted basis.
And that structural shift is profound. I mean, if you are a project sponsor, you are essentially asking an investment committee to allocate capital to your project over a conventional corporate bond or, say, a traditional private equity buyout.
Offering zero discount for the social good you intend to provide.
Precisely. Aspirational storytelling and compelling narratives have been entirely replaced by the need for data-driven validation.
Right. If a project cannot demonstrate a robust business model with clear cash flows, sustainable growth prospects, and an identifiable exit strategy, the impact narrative simply becomes irrelevant to the investment committee.
Because the fiduciary duty of these funds requires them to generate financial alpha first and foremost, with the impact serving as a parallel integrated mandate, not a substitute for yield.
Exactly. Because impact projects now compete directly with traditional assets, the financial metrics used to evaluate them must logically be equally rigorous.
When we review standard requirements for these data rooms today, we are looking at projected internal rate of return, detailed debt service coverage ratios, and highly comprehensive default risk assessments.
The financial modeling must withstand the exact same stress testing as any standard institutional deal.
But alongside those traditional metrics, there is an added mandatory layer for impact verification. Funds are increasingly demanding ex-ante impact targets.
What's fascinating here is the institutionalization of the impact metrics themselves. Vague assertions about creating the greatest possible social impact or broadly supporting a community will categorically fail to secure interest from disciplined impact funds today.
Categorically fail.
Right. Approximately 75% of impact funds now rely on standardized impact frameworks to assess and manage performance. They require quantifiable key performance indicators established well before the capital is deployed.
Those are the ex-ante targets. But I want to push back analytically on that framework for a moment. Isn't it inherently more difficult to project social impact with the exact same precision as a traditional debt service coverage ratio?
It is certainly a different type of modeling.
Right, because a financial model relies on contracted revenues, fixed operating expenses, and tax rates. Those are deterministic variables. Social outcomes often rely on secondary variables that are highly probabilistic.
I see your point.
So how do sponsors bridge this data gap when evaluating predictive social outcomes without losing credibility with those institutional investors?
Well, you bridge that gap by applying the exact same conservative forecasting principles to social metrics that you apply to financial revenues. Investors do not expect perfect prescience, but they do expect a rigorous, defensible methodology.
So it is about the structural integrity of the projection itself.
Exactly. Consider a sponsor operating a financial inclusion project, aiming to bank unbanked populations in a frontier market. The sponsor must establish clear baseline data prior to the intervention.
They have to quantify the current state.
Right. They quantify the current state, apply a transparent set of assumptions regarding the project's direct influence, and critically, they must discount for external variables. Things like macroeconomic shifts or competitive market entry.
Much like running a sensitivity analysis on a revenue forecast.
Precisely. When an institutional investor reviews the data room, they are evaluating the methodology behind the projection just as scrutinizingly as the final projected number itself.
And during this due diligence process, specific red flags frequently terminate discussions, don't they?
Oh, absolutely. The most prominent red flag is a weak alignment between the core business model and the stated impact claims.
If the impact requires a completely separate operational effort that drains resources from the commercial engine, that is viewed as a massive risk.
A massive risk. Other major deterrents include a lack of measurable baseline data to substantiate previous impact claims and a management team that presents an unclear value creation strategy.
I mean, if the social or environmental impact does not scale proportionally and naturally with the commercial revenue, the deal structure is just inherently flawed.
It is. Now, once those models and metrics are established, audited, and validated in the data room, they must be legally enforced over the lifespan of the deal.
Right, and over the past decade, we have seen a significant evolution in how term sheets are structured to accommodate this dual mandate. Here's where it gets really interesting.
It really does.
We are seeing a growing use of impact covenants that legally bind companies to measurable environmental or social outcomes, like actively serving a specific number of low-income communities or reducing carbon intensity per unit of production.
We are also seeing debt structures that incorporate tiered pricing.
Yes, this is essentially equating tiered debt pricing to a corporate mortgage, where your interest rate drops specifically because you proved a predefined social outcome.
That is a great analogy.
So how does introducing these legally binding social metrics fundamentally reshape a management team's day-to-day operational priorities?
Well, it forces total integration between the operational divisions and the impact tracking mechanisms. These deal structures make progress on social or environmental metrics a strict condition of continued financial support.
Or an optimal cost of capital.
Exactly. In a tiered pricing debt structure, often referred to as a sustainability-linked loan, the interest rate adjustments directly impact the company's bottom line and free cash flow.
So if a chief financial officer knows that failing to hit a quarterly carbon reduction target will trigger a step up in their interest rate, achieving that target is no longer a peripheral corporate social responsibility objective.
It becomes a core financial imperative.
It effectively weaponizes the capital structure to ensure compliance. I mean, for a chief financial officer listening to this, missing an impact target under these modern term sheets is no longer a public relations issue. It's an immediate liquidity issue.
The cost of debt rises instantly. And it is potentially a governance issue as well.
Oh, so?
Well, in equity deals, term sheets now routinely mandate board seats for impact investors to ensure strict governance oversight. The legal mechanics of these term sheets ensure that the impact thesis is protected throughout the life of the investment.
Right, so if a management team misses an impact covenant, they're not just failing a social goal, they're potentially triggering a technical default.
Exactly. This immediately escalates the operational failure to the board level, granting the institutional investors the legal leverage to intervene. They can demand remediation plans or, in extreme cases, force leadership changes.
The legal framework guarantees that the impact and the commercial performance remain inextricably linked.
Absolutely. And these rigid term sheets and massive capital requirements are arguably most heavily tested in emerging markets and developing economies.
Which is where commercial risk is often perceived as the highest, yet the development gap is the widest.
Right. The estimated investment needs for development and climate goals in these regions sit at roughly $7.5 trillion annually.
7.5 trillion US dollars.
Yeah.
Annually.
Yes. The Sustainable Development Goal financing gap remains multi-trillion annually through 2030, and public budgets are currently covering less than 33% of these needs.
Less than 33%. So to bridge this deficit, there is a critical reliance on blended finance structures.
If we connect this to the bigger picture, The role of blended finance is the definitive mechanism for mobilizing private capital at the necessary scale in these challenging environments.
Let's break down how that actually works for the listener. Blended finance utilizes concessional capital to form a minority share of the capital stack.
Concessional capital being financing provided by public or philanthropic entities that offers below-market rates, longer tenors, or assumes a subordinated first-loss position.
Right, so this specific tranche mechanically absorbs or mitigates commercial, regulatory, or macroeconomic risks that would otherwise deter private investors.
By buffering those risks, it makes the remaining senior tranches attractive to institutional capital.
Let us ground that in the data, because
Yeah.
the volumes we're discussing emphasize how standard this practice has become. Private finance mobilization now exceeds $70 billion annually.
70 billion US dollars. And recently, multilateral development banks mobilized 87.9 billion US dollars in a single reporting year.
And when we isolate the blended finance market specifically, it reached 18 billion US dollars across 123 deals in the latest reporting year.
The majority of this capital is highly targeted. Climate-focused deals took 15.5 billion US dollars of that total.
Geographically, this activity is heavily concentrated in Asia and Latin America, where the intersection of market scale and climate vulnerability is most pronounced.
Cumulatively, private finance mobilization surpassed 600 billion US dollars between 2012 and 2024.
600 billion US dollars is massive. But mobilizing these volumes requires strict adherence to international frameworks. The OECD outlines key principles for high-quality blended finance, heavily emphasizing transparency and additionality.
Additionality is a term that gets utilized frequently in these data rooms.
For the institutional investors listening, how should they evaluate true additionality in a proposed deal structure?
Well, additionality means that the concessional capital must lead to investments and outcomes that would not have occurred otherwise.
So, if a commercial bank was willing to fund a renewable energy project on its own, injecting concessional capital into that deal violates additionality.
Exactly, because it merely subsidizes a project that was already commercially viable. The concessional tranche must be the deciding factor that flips a project from uninvestable to investable.
That raises a highly strategic question about execution for anyone modeling these transactions. How does a project sponsor effectively structure a deal where the concessional capital acts as the precise catalyst to mobilize private investment without distorting the commercial incentives of the broader market?
That is the most critical balancing act in development finance. Concessional capital must be deployed with absolute precision.
Meaning it should only absorb the specific risks that the private sector cannot currently price or manage.
Precisely. For instance, early-stage technology risk in a utility-scale battery storage project, or specific currency convertibility risks in a frontier market. The commercial tranches of the capital stack must still carry appropriate risk-adjusted returns.
And the management team must remain fully incentivized to achieve profitability.
Yes, because if the concessional tranche is miscalibrated, the systemic effects are highly detrimental.
Right. If the concessional tranche is too large, it crowds out private capital and subsidizes inefficiency. It creates a market distortion where competitors without subsidies cannot survive.
But if it is too small, the risk profile remains uninvestable for institutional players, and the capital raise fails.
So sponsors must clearly demonstrate to commercial investors that the concessional capital is a temporary bridge to market viability, not a permanent subsidy.
The financial model must show a clear trajectory where subsequent rounds of financing or future projects will not require the concessional buffer.
Knowing the strict legal structures, the rigorous mathematical requirements, and the blended finance mechanisms available, we have to look at how fundraising teams successfully present these integrated strategies.
In practice, how does a sponsor optimize their pitch deck and data room for 2026?
It requires presenting a clear theory of change. This is a framework that directly and logically links the company's day-to-day business activities to measurable long-term outcomes.
But if I am a private equity leader reviewing that theory of change, I'm looking for something far more robust than a flowchart.
Exactly. A theory of change cannot be theoretical. It must be operationalized within the financial model.
This requires the absolute need for credible impact metrics, verifiable baseline data, and highly measurable performance targets that tie directly back to the revenue model.
So when you claim that expanding your logistics network will reduce post-harvest agricultural losses by 20%, the data room must contain the baseline studies of current loss rates.
It must contain the specific technological interventions and the audit mechanisms you will use to verify the reduction.
The documentation must be airtight. But beyond the data and the modeling, institutional investors place immense scrutiny on the human capital responsible for executing the strategy.
There is a growing critical importance placed on experienced management teams capable of executing both financial and impact strategies simultaneously.
Right. It is not enough to just have a visionary founder who understands the social mission.
Not anymore. You need a chief financial officer who understands institutional reporting standards, who can navigate complex blended finance capital stacks, and who knows how to manage liquidity when an impact covenant threatens a margin step up.
You need operational leaders who can deliver against both production quotas and environmental metrics without viewing them as conflicting goals.
And the standards for these data rooms are set by the largest players in the space.
Institutions like the International Finance Corporation, with total assets exceeding $100 billion dictate the market norms.
They require rigorous due diligence, absolute financial transparency, and institutional-grade governance standards to be fully implemented well before they are even approached for funding.
If your data room does not meet their environmental and social performance standards from day one, the conversation simply does not advance.
They establish the baseline for what institutional capital expects. Even if a sponsor is not raising capital directly from a top-tier multilateral development bank, the private equity funds and commercial banks they are approaching have adopted those exact same frameworks to manage their own risk.
So what does this all mean? It means that a modern data room is no longer a collection of aspirational goals. It is a rigorous, evidence-based proof of concept for dual returns.
It proves to the investment committee that the commercial engine and the impact engine are the exact same machine.
Right. Every dollar of revenue generated organically produces a quantifiable unit of impact, and both are tracked, audited, and legally bound by the term sheet.
Precisely. And this leads to a final consideration you must evaluate before entering the capital markets. Whether you are leading a development finance institution, managing a private equity portfolio, or founding an enterprise in an emerging market, you must objectively assess your own architecture. Are your internal institutional standards, your governance discipline, and your frameworks for measurable impact verification truly robust enough to withstand the scrutiny of top-tier impact investors today?
This has been Delphos Insights. Learn more at delphos.co.